Everyone nods along when stocks come up in conversation. But ask what a stock physically is, and the room goes quiet. Nobody wants to be the person who admits they never learned this. So here it is. From absolute zero in under 10 minutes, a stock is a slice of ownership in a company. That is it. Say a company is chopped into exactly 1,000 pieces. You buy 10 of those pieces. You now own 1% of it. But here is where almost everyone builds the wrong mental picture. Owning shares does not mean you own the building. You cannot walk into the head office and claim a chair. You do not own the desks, the factories, or the coffee machine. What you own is a claim on the company's future profits. Not what it made yesterday, what it earns from today onward. That distinction matters more than almost anything else here. So now the obvious question, why would a company do this? Why give away pieces of yourself to complete strangers? Because companies need money, and there are only two ways to get it. Option 1, borrow it, which means a bank and a repayment schedule. Interest payments every month, whether business is good or terrible. Option 2, sell slices of the company instead. No bank, no interest, no repayment date ever, which sounds like free money. And that is exactly the trap, because the company just gave away a cut of every future profit. Not for a year, not for 10 years. Permanently, a loan ends. Selling a piece of your company never does. It is a trade, and someone came up with it 400 years ago. Amsterdam, 1602, the harbor is crowded with wooden ships. These ships sail halfway around the world for spices. Roughly half of them never come back at all. Funding one voyage alone could destroy even a wealthy merchant. So the Dutch East India Company tried something nobody had done. Instead of one rich backer, they invited everyone to invest. Any resident could buy in. That had never happened before. One voyage's risk split into thousands of small pieces. Investors came and went from that house all month long, and a maid working in that house watched every single one of them. Her name was Neeltgen Cornelis, and she was not wealthy. Near the end of the month, she walked up and invested 100 guilders. A housemaid became part owner of a global trading empire. That moment is basically the birth of ordinary people investing. But then a problem nobody had planned for showed up. Thousands of people owned shares, and some of them wanted out. So they started meeting up to buy and sell them from each other. Nobody designed it. It just formed on its own out of necessity. That accidental gathering became the Amsterdam Stock Exchange. And remarkably, that exchange is still operating today. So that is where it came from. Now, how do you actually profit? There are exactly two ways. Only two. That is the whole list. The first is a dividend, cash the company pays you from profits. It just lands in your account, usually every few months. The second is simpler. You sell the slice for more than you paid. That is it. Dividends or selling higher, nothing else exists. But here is what catches beginners completely off guard. Plenty of huge companies never pay a single dividend at all. They pour every dollar of profit straight back into growing. So those shares only pay off if the price actually climbs. Two more terms, and you will hit both within 1 minute of any app. Take the share price, multiply by every share that exists. That total is the market value of the entire company. It is not a fact. It is just the market's collective guess. The other term splits shares into two very different types. Common stock is what almost everyone buys, and it comes with a vote. Preferred stock usually has no vote, but pays a steadier dividend. And if the company collapses, preferred holders get paid back first. So now you know what a stock is and how it makes money. Which brings us to the part almost nobody ever learns. Tomorrow morning, you open your app and buy Apple stock. Apple receives exactly $0 from that purchase. Not a cent of your money reaches the company, none of it. Because a company only ever gets paid once at the very beginning. When it first sells its shares, that money goes to the company. Every single trade after that happens between investors only. Your money went to whoever sold you those shares. A stranger. Which raises one last question. Who sets the price then? There is no committee, no boardroom, nobody decides it. A stock price is just whatever the last two people agreed on. One handshake between strangers, repeated millions of times a day. That is why the number never sits still for even a second. And it moves because a stock is a bet on future profits. Change what people expect a company to earn, and the slice changes value. There is one last protection worth knowing before you ever buy. If the company collapses under debt, creditors cannot touch you. Your house, your savings, your car, all of it stays yours. The worst that can happen is your shares go to zero. That protection is the entire reason any of this works. So step back and look at what a stock actually is. 400 years ago, it split one dangerous voyage into pieces, so a maid could own a sliver of a fleet she would never board. That exact same idea is sitting in your pocket right now. So, what was the very first stock you ever bought? Tell me below, and subscribe for more breakdowns like this.